Hello Rogers TV, welcome to Smart Money, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host, Mitchell Huynh. This week we'll be speaking about the different factors you will need to consider when putting together an investment portfolio. To do so, we will need to discuss the basic principles of risk-return trade-off, the various aspects of diversification, the efficient market hypothesis, and the different investment vehicles or tools we have at our disposal in this context. First, we need to identify the difference between saving and investing. Saving, simply put, is the leftover money you did not spend. Investing is putting those savings to work to earn a rate of return to achieve a specific financial goal. Every investment should have a quantifiable goal. Ideally, you should have a good idea of how much you will need and how long you have to reach your goal. From there, you can determine the rate of return you will need. Next, we move on to asset allocation. Depending on the rate of return needed, you would spread your portfolio over cash, bonds, fixed income, and equities, or stocks. Certain investment returns are more tax efficient than others. Therefore, it's wise to research the tax implications of the asset classes in your portfolio, since if you are taxed more heavily on some assets than others, this will affect your overall take-home returns. While this method is great in theory, it is also prudent to have a good measure of your risk tolerance. If you will panic when the portfolio drops, it may be wise to invest in lower risk, lower return asset classes. While if you're unfazed by any losses, higher risk, higher returns may be the correct path for you. These feelings of excitement or panic will have a drastic impact on the results of your portfolio. Investing is often described as an emotional roller coaster, with the investor feeling encouraged, confident, and then excited while the portfolio is growing, to feeling agitated, distressed, and despair while the portfolio is dropping. Mistakes generally occur during the highest point of the ride, excitement, where investors will buy more of an overvalued asset when instead they should be selling and taking profits. And the lowest point, despair, where investors will be panic selling their portfolio when they should be holding and buying more in anticipation of the ride back up. When investing, it would be wise to leave your emotions out of your decision making, as a study from the American Psych Society found that investors who had suffered brain damage made better financial decisions than those who hadn't. Financial success is driven more so by the behavior of investors rather than the performance of the investments. So stay calm and invest on. Next, we move on to diversification. Diversification is one of the most effective ways to reduce the risk of your portfolio while maximizing returns. In simplest terms, it is putting your money into a broad basket of investments. When choosing these investments, it is best to pick ones that are not highly correlated. Investments which are correlated will move similarly. Therefore, they will move up or down together, which means it is safer to have investments which move differently. Thus, when one investment is going down, your other investments can still be going up. There are three dimensions to diversification. You can diversify between asset classes such as cash, bonds, and equities or stocks. You can diversify within asset classes, such as different types of equities or stocks. One way to do so is to own equities in different market sectors, such as banks from the financial sector, large companies such as Google and Facebook from the tech sector. You can also diversify by owning assets in different countries, such as owning equities from Canada, the US, Asia, Europe, or the emerging markets. By doing so, you can take advantage of the strengths and weaknesses of each region. If we take a look at the different sectors of the market, we see that when a sector outperforms the general market, for example, the Canadian small cap gained about 42% in the year 2003, but only returned 14% in 2004 and a measly 2% in 2007. The following years, that sector generally underperforms the general market. This is due to the rest of the market catching up to the outperforming asset, as well as other investors rebalancing their portfolio, which means selling what is overvalued to buy what is undervalued. As you can see, a diversified portfolio, which includes many markets, reduces volatility while still achieving strong, smoother growth. Your objective will be to build a well-diversified portfolio and hold it over the long term, which also smooths out the growth, as we already know that over the long term, the markets have always trended upwards. The easiest way to put together a strong portfolio is through the use of mutual funds. We have briefly spoken about mutual funds in our previous episodes, but here's a quick recap. The advantages include funds are professionally managed, there's broad diversification, they have reliable estimates of returns and risks, they have past records of performance, there's flexibility for purchasing and selling, and they generally have automatic reinvestment plans. The primary drawback is the management expense ratio, which is the MER. This fee may fall anywhere between 1.5 and 2.5% on average, which will chip away at your returns. However, in the big picture, this may be a small price to pay for a professionally managed fund, and it is unlikely that a typical investor can outperform a fund manager and their team of analysts. Stay tuned as we put together a sample portfolio for today's market conditions. Taking a look at the most recent market conditions, the end of June saw the North American markets opening lower as they tracked the European markets over the uncertainty of the impact of Brexit. Brexit caused a global market sell-off which eroded $2 trillion worldwide, the biggest one-day loss ever, even trumping the Lehman Brothers bankruptcy during the 2008 financial crisis. The European Banks Index hit its lowest point since July 2012. This stretched to a $3 trillion sell-off over 2 days. The world oil market was not greatly affected, as Britain leaving the EU will have little impact on the demand of oil. At this point, most investors would be running for the hills. However, if we take a slightly deeper look, we see that the drop was mainly due to a lack of confidence in the markets, as there is a lot of cash on reserve, and low interest rates will provide a catalyst for cheap borrowing as investors begin to enter the market to bargain hunt. We observed this behavior a few days later as the TSX and the Dow indexes rise as investors start buying up beaten up assets. In other words, there was a huge sale and everyone went shopping. North American banks, which were hit the worst during the Brexit sell-off a few days earlier, experienced the greatest rebound as these were the most attractive stocks for bargain hunters. The S&P 500 showed its strongest two-day climb in 4 months on speculation that central bankers will counter the impact of Brexit. However, fears that the impact of the UK leaving the Euro Union will slow global growth remain strong. During the first week of July, Canada's main stock index rallied to a 4-week high on the Monday, led by mining stocks as gold and silver climbed, while financials and energy also advanced. As mentioned previously, whenever there is market uncertainty, investors tend to sell higher risk stocks and move into precious metals such as gold and silver, bonds, as well as cash. On Tuesday, still within the first week of July, country data from China showed the services sector rose to an 11-month high in June, but a composite measure of activity including manufacturing, which is one of China's biggest revenue streams, fell to its lowest in 4 months. The Bank of England lowered the amount of its capital reserves its banks were required to hold for lending. Capital reserves is a percentage of liquid funds banks need to have on hand. This is to ensure that if everyone went to the bank to withdraw all of their money, the banks would be able to at least provide some funds. By lowering the capital reserves, banks can lend more money, thus increase their profits. Generally, this would be a safe practice provided that loans that the banks issue are high-quality loans and only a small portion of them go bad. However, it is important to note low capital reserves were one of the factors that led to the financial crisis in 2008 due to the high volume of below-grade loans. You can bet that the Bank of England's push to make loans cheaper and interest rate drop is on the horizon as well, thus causing the value of the pound to fall. Both China and Europe also allowed the yuan and the euro to fall relative to the dollar. Then on Friday, Following an impressive U.S. jobs report showing strong job creation, the TXX rose again, even though domestically, our own job markets was underwhelming. So what did we learn from all of this? Where is the market going? Interest rates will not increase in the U.S. for the next little while, meaning they're still focused on growth. Interest rates will not decrease in Canada as oil prices have stabilized. The market overreacted to the news of Brexit as usual, and globally, leaders are working together to prevent any further fallout from Brexit. In very broad general terms, when we invest with a diversified portfolio, we only need to be directionally correct and not exactly correct, partially because being exactly correct is near impossible. And as we discussed previously, as long as our portfolio is well diversified, we will enjoy the gains as the markets grow. We just need to pick the right markets at the right time. China, still slowing down from last year. As China is a big factor in the Asian markets, now is not the best time to put the bulk of our money there. The UK, Europe, Brexit, blah. Let's not go there for a little while. Emerging markets, not too much news coming from them, which is both good and bad. US markets show some opportunities. Canadian market has been underperforming the US market for the past several years, which is why the Canadian market has been showing relatively strong gains recently. Oil prices have stabilized. Mining is a strong industry in Canada. And we know that investors love precious metals when times are rough. All pluses for the Canadian market. So now, what about our portfolio? Before we begin, I'd like to point out that these are my personal recommendations for a long-term diversified portfolio, which will need to be rebalanced periodically as global markets shift. For up-to-date portfolio mixes and my quarterly market update newsletter, be sure to email or follow me on Twitter. So this is a moderate portfolio with emphasis on undervalued sectors of the market. We want to have a good amount of exposure to the Canadian markets for the reasons listed above. Primarily, the Canadian market has been underperforming for years. Oil and natural resources are a big part of the Canadian market, which is undervalued. There's exposure to mining and precious metals. And the financial system in Canada is one of the most stable globally, as we have seen from the 2008 financial crisis. So our first fund should be a Canadian Balance Fund. Our second fund should be a Canadian Strategic Income Fund for all the reasons just listed, as these funds have the primary goal of generating regular income through bond and dividend payouts, meaning that even if the market goes up or down, you will still be getting these payouts to your portfolio, thus cushioning your losses or strengthening your gains. Also, in times of uncertainty, investors will overweight themselves with bonds, which means the value of the bonds will increase, as per our demand and supply discussion previously. Our third fund should be a Canadian Dividend Fund, which is quite similar to the Strategic Income Fund, except the focus is on dividend payouts rather than bond and interest payouts, as in the Strategic Income Fund. Our fourth fund should be the Fixed Income Fund. This is primarily a bond fund with exposure internationally as well as in North America. Higher risk countries tend to offer higher interest payouts, thus increasing our fixed income gains. Our primary risk would be the countries defaulting on their debts and not paying the bond payments. However, this is unlikely to happen. Our fifth fund should be the Low Volatility Canadian Fund. This is essentially a fund that is focused on all the major players in the Canadian market, most of the big banks and energy. Once again, because right now Canada is awesome. Our sixth fund should be the U.S. Opportunities Fund. This is a higher risk fund which looks for undervalued U.S. assets. As the U.S. market is still strong, when these assets catch up to the market, we should see substantial gains. Our seventh fund should be a Foreign Equity Fund. Also a high risk fund because it's high concentration in equities in foreign markets, which at the moment are not doing so well. When picking high risk funds, try to look for funds which have a high concentration of cash right now. This means that the portfolio manager is actively looking for opportunities in the market and is waiting for the right time to buy. This is always a good sign. And lastly, our eighth fund, if you want a little bit more risk in your portfolio, the Canadian Natural Resources Fund would be a nice pick. Since oil has been taking a beating recently, there is still quite a nice recovery possible that we can take advantage of. So now that we have our 8 funds, how much of each should we buy? The market as it stands is still very volatile, so we don't want to put all of our money in at once. We want to buy a little and then some more if the market falls. This allows us to lower the average cost of each investment. In volatile markets, always keep cash on hand to look for buying opportunities, like Brexit. So if we had $100 to put aside, we should be investing $30. And here's how we should split up that $30. $5 into the Canadian Balanced Fund, $4.70 into a low volatility Canadian fund, $4.20 into a Canadian dividend fund, $4.20 into a fixed income fund, $3.57 into a strategic income fund, $2.85 into a U.S. opportunities fund, $2.85 again into a foreign equities fund, and lastly, our flavor pick to spice up your portfolio, $2.63 into a Canadian natural resources fund. With these allocations, we still have $70 to shop around with. And if you guys are anything like me, I can't resist a good sale. So keep your eyes and ears open for buying opportunities with the leftover $70. Generally, you want to buy more of these funds in the same proportions. That's all the time we have for today. If you'd like me to analyze your current portfolio, or if you'd like to receive my quarterly market updates and portfolio recommendations, email me at mitch@smartmoney.ca. That's mitch@smrtmoney.ca. Or tweet me at Mitchell Huynh. Thank you.